The FTX collapse has been storming the headlines on social media, but what exactly happened, how bad is it, and should we all be panicking or taking away some key lessons? I'll be answering all of your questions today in this short video and highlighting 5 key lessons that you should take away from the FTX collapse. So hit the like button, grab some popcorn, and let's dig in. First things first, what is this FTX collapse that everybody's talking about? It's too complicated to cover in detail in just this one video, but here's what happened in a nutshell. FTX is basically a digital currency exchange where people could buy and sell digital assets like Bitcoin, similar to its competitor Coinbase. FTX began to grow in popularity over the years, and Sam Bankman-Fried, SBF, became the face of the company and even an important face in the crypto world. Not soon after SBF started FTX, the price of Bitcoin boomed to its peak of over $64,000, but then it began to drop dramatically, which had a knock-on effect on other tokens. And that's just because many crypto coins follow the same pattern as Bitcoin, which is the principal cryptocurrency. So when the value of Bitcoin dips, so does the value of pretty much most other coins. In turn, this seriously affected pretty much every crypto platform, which ended up either struggling or closing down, except for FTX, who used this as an opportunity to acquire their struggling competitors. And here we have lesson number 1 to take away from the FTX collapse. Crypto is a nascent industry. It's new, just coming into existence and gradually shaping up to meet its future potential. We can see this from the pullbacks of various tokens, and that's important to keep in mind when deciding if you want to invest in crypto and how to approach it if you do. So, all was going well for FTX until CoinDesk published the balance sheet of a crypto investing firm that was also owned by SBF, Alameda Research. The publication showed that Alameda held a large amount of FTT, a digital currency like Bitcoin, but created by FTX. Alameda held such a large amount of FTT that if the value of this token were to drop, Alameda would fall into insolvency. Many crypto platforms create their own digital currencies, and these tokens act like stock in the platform. So the existence of FTT wasn't really the shady part. Here was the problem with FTT. FTT was minted by FTX and given out to users as rewards, but nobody really knew anything about the FTT tokens, like how many of them were created. People could buy and sell FTT, but trading was very limited. And this brings to light lesson number 2. Putting money into crypto is often speculation and not investing. Most people who put money into crypto projects do not understand the fundamentals of blockchain. They don't understand the specific project that they're investing in. If you do not understand what you're investing in, you are not investing, you are speculating. And this was one of the biggest reasons why so many people lost so much money through FTX. That's not to say that FTX shouldn't be held accountable for misleading people. Now, here's when things really took a turn. After Alameda's balance sheet was leaked, Changpeng Zhao, the CEO of Binance, which was somewhat of a competitor of FTX, announced that his company would sell off all their FTT tokens. So, of course, the price of FTT dropped sharply. And so, FTX users went to withdraw their assets from the platform because things were looking shady, even though the connection between Alameda Research and FTX hadn't fully come to light. Like with the classic bank runs, everybody rushed to withdraw their money from the platform, fearing that FTX would run out of cash. The platform let go of billions of dollars, and on November 8th, FTX stopped letting customers withdraw from the platform. Some of the biggest media organizations, such as the Financial Times, Bloomberg, and the Wall Street Journal, cited anonymous sources that said FTX needed $8 billion to cover the gap between what they owed and what they could pay out. SBF essentially confirmed that funds had been moved between FTX and Alameda, and that he thought Alameda had enough collateral to cover the moves. Shortly after, $400 million of assets were moved out of FTX accounts, which was tracked by blockchain analysts. SBF claimed that they weren't trying to sneakily move the funds from one company to another. It was just an unfortunate mislabeling incident. Nobody can understand what really happened with the funds and the money, and the reason for that seemed to be that FTX and its sister companies never followed the standard financial reporting procedures. SBF's firm's balance sheets were never audited, so there's no real paper trail of what money the company had, nor where it went. That brings us to lesson number 3. There's a lot of shadowy stuff going on in the crypto world. FTX had been seen as one of the saviors by propping up failing crypto companies, but now it's come to light that even FTX had done a bunch of sketchy things and moved moved billions of dollars around, creating huge holes in their balance sheets without any oversight or auditing whatsoever. Binance CEO Zhao came forward with a proposal to buy FTX. Binance was meant to purchase FTX for an undisclosed amount, but Zhao backed out pretty much immediately when he came across sources that essentially said FTX had mismanaged user funds. SBF posted on Twitter,
"I f***ed up and should have done better."
He stepped down as CEO of FTX on November 11th, and he filed his companies for Chapter 11 bankruptcy. FTX is now being investigated by the Securities and Exchange Commission and the Department of Justice, and there's more and more information coming out. This brings us to two more key lessons to take away from the FTX collapse. One, there is a serious need for regulation in the crypto world. While one of the advantages of cryptocurrency is that it's self-governed, this can actually lead to many problems, such as scammy crypto projects, many of which we have seen collapse over the past year. We need some form of regulation to make sure that crypto and blockchain don't implode anymore, and that people can protect their billions and billions of hard-earned dollars while still allowing the crypto world to remain innovative enough to change the nature of finance as we know it. One of the biggest questions is whether SBF was truly clueless about what was going on with his companies and their finances, or if he knew exactly what was going on but used ignorance as a way to avoid the consequences of one of the largest collapses in the unregulated crypto world. Unlike Coinbase, FTX didn't actually build its trust and credibility through regulation, but rather through reputation. And SBF built that reputation through several ways, such as political lobbying, which can also be regarded as being sketchy, smart marketing, and being connected and associated with the right people, political and tech leaders. The rise of FTX's valuation also helped build what seemed to be a solid reputation, but which has been crumbling down in the light of information that has been coming out and is still coming out. The final lesson for today: crypto is not dead. Disasters like the FTX collapse have really hurt the industry, but fundamentally, blockchain technology is here to stay. Areas like decentralized finance or DeFi and NFTs still have a lot of potential ahead of them. There are thousands more tokens today than at the beginning of 2022. People still believe in the technology, and developers are still using it and creating new projects, and people are still putting money into it. They might be speculating rather than investing, but they're still putting money in. We don't know how this will all play out, but although there have been major disasters in the crypto world, we're only at the beginning of what we have no doubt will be a crazy but world-changing crypto journey. What do you think? Does the FTX collapse show that crypto is dead? Was SBF really just clueless this whole time, or was he using his ignorance to cover his criminal tracks? Let us know in the comment section down below. And if you enjoyed this video, be sure to hit the thumbs up button and subscribe to the channel with notifications turned on so that you never miss out on some incredible personal finance and investing tips that will bring you one step closer to your financial freedom. See you next time.